Thanks for clicking. My name is Mark Mitchell. I'm a mortgage broker here in London, Ontario. The Bank of Canada released a report last week which looked to see whether or not there were characteristics of people's mortgages that could predict whether or not they were going to have trouble paying their bills or experience financial distress in the event of an economic shock. So the report wanted to look at certain factors such as loan to value, length of mortgage amortization, income, credit, etc., and whether or not those factors could predict whether or not people would suffer severe financial distress in the event of a major shock, such as, in the study, the oil shocks of 2014, where the price of oil plummeted and a lot of people lost their jobs. So the report looks at 260,000 mortgages in Alberta, Saskatchewan, Newfoundland, and Labrador, and seeks to see if these mortgages can predict economic distress. So I want to do briefly is just go over the report, see which factors were identified as being able to predict financial distress, and what that tells us for the future. And I think there's some interesting conclusions, especially at the policy level, as they have been talking about making changes to our mortgage requirements. So I think this report kind of will give us a good hint into what kind of data they'll be looking at when they're making those changes. We will have more data out at the end of the week, as there should be some real estate data being released for London, Ontario, and for countrywide at the beginning of next week. So click like and subscribe to get those updates. But for now, let's get into the report. So as mentioned, the report looks at 260,000 mortgages and looks at people that were late by over 60 days on some source of credit. So it could be credit card, line of credit, auto loan, etc., etc. So when we go over the report, some of the initial results really aren't overly shocking. So those with insured mortgages, that's with less than 20% down. Those that had even smaller amounts of down payments were more likely to experience financial distress. So if you had 15% down, 3 years into the mortgage, you were less likely to have financial distress than if you started with only 5% down. Big surprise, those with more money have less financial distress. And in other news, water's wet. The study showed very similar results to the insured market. So if you had over 20% down but less than 35% down, you were more likely to experience financial distress within the first 3 years than you were if you had over 35% down. So again, more money, less financial distress in the event of an economic shock. That's not a big surprise to everybody. We all kind of intuitively knew that in the past. But this study actually looks at the data in a period that they can actually look at when we had the oil shocks. So I think that's really interesting that we're actually seeing a large-scale data analysis completed by the Bank of Canada, our central bank, actually showing this mathematically on paper, what happens when there is an economic shock and how the more equity actually does decrease the risk. But what I think was even more interesting was that the 30-year amortization showed to be particularly risky, which I find to be really interesting because if you'll remember, during the election, the NDP and Jagmeet Singh wanted to increase the insured amortization period. So right now, if you have an insured loan that's less than 20% down, you have to amortize your mortgage over 25 years. They wanted to increase that to 30 years, so you could have less than 20% down and increase your amortization to 30 years to qualify for the mortgage, but also for what you paid for on the mortgage. So not only would that make it easier to qualify, but you would also make lower monthly payments. But as we said during the election on a few videos on this channel, this would also decrease the total amount of equity you would have after a few years. And I think, as this report shows, this would also increase your susceptibility, increase your exposure to external shocks. So if the economy goes bad and you took that 30-year amortization, especially with a smaller amount down, then you're going to be much more susceptible to financial stress, or another way, be more likely to miss payments on other lines of credit or even your mortgage. So I think that really shows something that this report even saw from the data, and this is with people that had been putting 20% down, were more likely to have financial stress. If people that put even less down and were still able to go on a 30-year amortization, they would be even more susceptible to risk than they are now. So I think that's really important, and I think that's really the key takeaway of this report, is what it shows for people with 30 years amortization. So as Prime Minister Trudeau has promised to make housing more affordable, he does have a minority government, which means he is going to have to make some deals, some concessions with the opposition parties, and the NDP wanted to have that 30-year amortization. That was a big part of their selling points, to make housing more affordable for Canadians. So I think this report released by the Bank of Canada is of particular note, because it does show that, yes, it will make housing more affordable for people, but in the event of an economic shock, like, say, I don't know, COVID, it could definitely make it much harder for people to pay their bills and give them much less of a cushion in the event that something happens. And as we saw in 2008, when we have an equity problem, it can spread throughout the country and to other places, other financial sectors. So I think that's an important note to think about when they're thinking about their policy decisions going forward. We will have more data out at the end of the week, as we mentioned, and at the beginning of next week. So please do click like and subscribe to get those updates, and thanks for watching.